afternoon. Welcome to McAfee and Taft's Employer Link webinar. My name is Richard Nix, and I'll be the moderator today for the presentation, Are You Ready for Fee Disclosures? Before we begin, there are a few housekeeping items that I'd like to take care of. First, today's webinar will be 1 hour in duration, ending around 1 o'clock Central Time. Approval of HRCI credit is currently pending. Once we receive notification of that approval, we will be sending everyone pre-registered for the HRCI credit a follow-up email with program details. Secondly, you should see near the top of your presentation screen a Q&A tab during the course of our webinar. The Q&A tab allows you to submit questions electronically. There will not be enough time to address all the questions during our hour presentation. However, next week, the answers to the most frequent questions will be available on the webinar's webpage on our website. We will provide a link to that webpage when we send out the follow-up survey email. We certainly encourage you to respond to our survey. That is the best process for us to improve our webinars going forward and also making sure that we are touching on the subjects that are most interesting to you. With that, let's turn now to today's subjects. Are you ready for fee disclosure? Joining me today are Jim Prince and Bill Frudenridge, both employee benefit attorneys at McAfee and Taft. We'll talk today about the Department of Labor's new fee disclosure regulations that take effect this year, what these new fee disclosure regulations mean for employer sponsors of plans, and also help you strategically prepare for upcoming spring deadlines and assist you in avoiding the penalties and liabilities associated with noncompliance. With that, I'll turn it over to Bill Frudenridge.
Thank you, Richard. In today's seminar or webinar, we're going to talk about fee disclosures, but we're going to divide the fee disclosures into two parts. Part one is going to be the fee disclosure that the service provider makes back to the plan sponsor or / plan, whoever's paying the fees. Second part of the webinar is going to be handled by Jim Prince, and that's going to be the actual fee disclosure that's made to the plan participants. So I'm going to start today discussing the rules, and these rules are going to be effective April 1, 2012. Now, that's the proposed effective date. However, there's been a lot of rumors and a lot of noise that this effective date is going to be pushed back. However, as of today, we do not have anything that's pushing back the effective date. So, as of today, we're going to act like we have to be in compliance as of April 1. Now, to start with, there's two key points. Number one, when you're making a fee disclosure back to the plan sponsor, number one, it has to be an ERISA-based plan. Thus, governmental, public trust authorities, cities, counties, states, they don't have to comply with these rules. Plus, the disclosure has to involve more than $1,000 in annual compensation. The third thing is these rules only apply if you're paying the fees out of plan assets. If the employer is writing the checks out of their general asset account or corporate accounts, you don't have to worry about any of these fee disclosures. Okay, I want to make it clear when we talk about fee disclosure back to the plan sponsor, this does not require a written contract. It just has to be a written disclosure. Okay? Now, to begin with, let's talk about who has to make the disclosure back to the plan. First, if you're a fiduciary as defined under ERISA Section 321 or a fiduciary under Section 338, you have to make a disclosure back to the plan on the fees that you're going to charge. Now, I'm going to save this because I'm going to spend more time talking about what is a 321 or a 338 fiduciary. Number two, if you are a record keeper or a custodian that's providing services to the plan and you're getting paid out of the plan, you have to do a fee disclosure back to the plan. And number three, now this is the interesting part, if you're an actuary, if you're an auditor, if you're an attorney, record keeper, third-party administrator, and any of your fees are paid out of the plan, you have to make a disclosure back to the plan. Now, this is where we think there could be some issues because I'm an actuary. I send out a fee letter, and I'm, disclosing my fees, well, you don't know whether those fees are coming out of the plan or not. For example, we are an attorneys, McAfee Taft. There are certain fees that we can receive and be paid from the plan. However, when I send a bill to the client for updating their plan documents, I don't know whether those fees are being paid out of the plan or if the employer is paying those out of the plan. Now, going forward, if I'm an actuary, attorney, record keeper, and accountant, I have to start asking those questions. And I have to make sure that my clients understand that there's certain requirements and certain disclosures that I have to make if you're going to pay my fees out of the plan. Okay?
And Bill, I might add to that, it's my understanding, and tell me if that's correct, the lawyers and accountants and actuaries need to be asking the questions, but ultimately the responsibility of making sure that is taking place falls on the plan sponsor.
That is correct.
They are the quarterback in this approach. They may not be doing a lot of the disclosure, but they need to make sure that it's being done.
Absolutely. That's a good point. Now, I'm going to discuss, if I am a service provider and I'm going to make a disclosure back to the plan, what do I have to include in every disclosure statement? First off, if I am receiving any direct compensation from the plan, I have to disclose what those fees are to the plan sponsor. Direct compensation would be direct legal fees, accounting fees, fees for preparing a 5500. Those are direct fees that are billed and paid by either the plan or the sponsor. If I receive any indirect compensation, I have to disclose it. Now, what's indirect compensation? Well, most of you are aware of the terms of revenue sharing, expense reimbursements. That's where the service provider / custodian, someone like Fidelity, Vanguard, whoever, Mass Mutual, that's where they are taking part of the compensation that's paid from the mutual fund company and they reimburse certain service providers. You as the plan sponsor never see those fees. However, if I'm receiving those fees, I need to disclose them. Related party compensation, that's if I'm the custodian, I'm Vanguard, I'm charging record keeper fees, I may have a actuarial firm that I own. If any related party is receiving compensation, I have to identify who all the related parties are. The next thing that has to be disclosed in these fee disclosures is termination expenses. Now, this is very important. I know this is a lot of work for employers, but the termination expenses, as an attorney, we deal with this all the time. And Jim and Richard, you can speak up, but we've had problems with this termination expense for 10, 15 years. What I'm talking about is when you terminate the contract, you get a fee saying, well, I'm not going to give you your records unless you pay me $2,000 to produce the records. Or, oh, I'm terminating this fixed income contract. There's a market value adjustment. You will not be able to charge these fees without entering into a prohibited transaction if you have not disclosed these to the plan sponsor prior to incurring the fees. Also, in our fee disclosure, you're going to have a detailed description of services that are provided. And the last thing I want to talk about is the statement of fiduciary status. Now, this is one of the reasons these regs may be pushed back. Well, it's very, very confusing on fiduciary status. And we'll spend more time on that. I don't have time to completely cover it today, but I just want to make some very important points. When I'm talking about fiduciary status, there's a lot of confusion in the industry on who's a fiduciary. We have a lot of trust companies, a lot of banks, a lot of independent fiduciaries who say, hey, I'm the plan trustee. You need to hire me because I'm your trustee and I have your fiduciary status. Well, that's not always correct. There's three types of fiduciaries. There's a directed fiduciary. A directed fiduciary is only responsible for what they are absolutely directed to do. A directed fiduciary doesn't even come under the definition of a 321 or a 338 fiduciary. Let me talk a little bit about what's a 321 fiduciary. A 321 fiduciary is one who has discretionary control over the management of the plan. They have discretionary control over plan administration. They provide investment services, and they declare their fiduciary status in writing. Now, that's a 321 fiduciary. They have a lot of control and management over the plan. Now, there's one step that goes further. That's the 338 fiduciary. The only difference between the 338 fiduciary and the 321 fiduciary is the 338 fiduciary. They have complete discretion over the management of the assets. They can initiate trades, they can stop trades, they can buy, and they can sell assets under the plan. Where normally a 321 fiduciary, they're still a fiduciary, but they don't have that liability. It's key because under a 321 fiduciary, that fiduciary has co-fiduciary liability with the plan sponsor. A 338 fiduciary, they have sole fiduciary responsibility for the management of those assets. Now, Richard, you were going to ask a question.
Well, and Bill, in a typical scenario, and obviously in qualified retirement plans, there's nothing typical. But in a normal arrangement, is it not true that normally defined contribution plans like 401k and profit sharing plans, they don't typically have or have not given over that full discretionary investment authority to an investment advisor? That's typically self-directed, et cetera. It doesn't have to be. But you would find typically in a defined benefit plan where they would have turned over the full responsibility.
Well, that is true, but I just want to make a comment on that. Normally we see the fiduciaries are either a directed fiduciary or a 321 fiduciary. However, we have larger plans who do not want to share any fiduciary liability at all, and through a board charter or an investment committee charter, they still oversee that fiduciary, but they have actually transferred that fiduciary responsibility to that 338 fiduciary, so they would have absolutely no liability.
But that is done with an affirmative action. And
affirmative action.
An employer shouldn't think they're covered under that unless they've taken that affirmative step and done that.
And that's right, and that's what these service agreements have to spell out. Now, I only have a few more minutes to cover this topic, but if we go to the next slide talking about service contracts. Now, let's talk about, okay, let's say I don't have a service contract or a contract from my 338 fiduciary or my 321 fiduciary, and I've paid them out of the plan. Well, the consequence of that is you now do not have a reasonable meaning of compensation, okay? Now, when I don't have a reasonable definition of compensation, if I haven't paid reasonable expenses out of my plan, I enter into a prohibited transaction. Now, if I have a prohibited transaction, I have a 15% excise tax. And that's a 15% excise tax that builds and multiplies each year. So again, make sure you have these contracts in place. You don't want to miss this because you could be responsible for the tax. Now, one last thing that you may want to have in your service provider contract is outline who's responsible for providing this contract and the notices to the plan sponsor and also the fee disclosures to the participants. Now, this is my cue to pass it off to Jim, and I'm going to pass it off to Jim, and he's going to discuss the fee disclosures to the plan participants.
Thank you, Bill. Let me back up just with a question for you before you get off.
Okay.
What in connection with the expenses? I'm just thinking these through, and specifically compensation that a service provider gets. We've got direct and we've got indirect compensation. Now, we always hear about 12B1 fees, which are what I understand are fees that a mutual fund may pay to somebody.
Well, basically, a 12B1 fee is a sales commission.
A sales commission for, and it's paid by the mutual fund to somebody who's making arrangements for the mutual fund to be part of the plan?
Absolutely.
Okay, so is that direct compensation? Is that indirect compensation?
That would be indirect compensation.
Okay, so if my service provider, my record keeper, is receiving those, that record keeper needs to disclose to me as the plan administrator, plan sponsor, the amount of those fees.
Absolutely, and how they're calculated,
and then what they're for. If
right.
It's a sales commission, that's what it's for.
That is correct.
Okay, good. Well, let me. With that said, let me then shift gears a bit and start talking about what disclosures plan sponsors and plan administrators need to make to their participants. In terms of timing of all this, I think Bill mentioned that the service provider disclosures to the plan sponsor and administrator, those rules are effective April 1st, Bill?
That is correct, Jim.
Okay. So the new requirements for disclosing information to plan participants are tied to that and are effective 60 days after the date that the service provider disclosures are in effect. So that would be May 31st for these new rules, unless you have a plan with a plan year that begins after that April 1st date, and then it's the first plan year that begins after that. So with that said, we've got these new disclosures to participants that are for the most part going to be effective May 31st. Again, unless these disclosure requirements get further delayed, and there's lobbying, as we mentioned, there's lobbying been done to have them delayed. So, first of all, let's talk about which plans these new disclosure requirements apply to, and that is that they apply to any plan that provides for the direction of investment by participants. And that includes 401k plans. It includes 403b plans. I might add the same thing that Bill talked about. They do not apply to plans that are not covered by ERISA. So your governmental plans that aren't covered by ERISA, let's say they are a 403b plan, would not be covered by these new requirements. I might also add they don't apply to SEPs, don't apply to simple IRA plans. Now, the idea behind these disclosure requirements is that a participant, if you're providing direction or providing a participant the ability to direct the investment of their account, then you got to provide them, one, with information about how they do that, and secondly, you've got to provide them with sufficient information with respect to the alternatives that are available to allow them to make informed decisions. And so, again, the plans to which these new rules apply are those which provide for participant direction of investment. Now, who must receive these new disclosures? And this is something that I think is fairly important. You need to maybe put a star next to this. We would anticipate that they apply to people who are participating in your plan. Now, but note that they apply to people who are quote participants in the plan, even if they don't have an account balance. So in a 401k plan, where you have a participant who is eligible to participate but is not making any contributions, these disclosures have to be made to that person, even though they don't have an account balance. The disclosures also have to be made to former employees who have account balances, and they have to be made to the beneficiaries of a deceased participant who has an account balance, and then finally to an alternate payee under a qualified domestic relations order who has an account balance with your plan. Then that's the key thing here is to make sure that you understand it's not just your employees that are going to need to be covered, but you're going to have to identify former employees, beneficiaries, and alternate payees as well. Now, the type of information that has to be disclosed is we can kind of break that down into 3 or 4 categories of information. The first is we've got to provide them with some general plan information related to investments. And basically we need to tell participants when and how they can give their directions and provide them with any limitations. For example, if there's a numerical limitation, if a person can only make a change in investment once a day or once a quarter, those limitations have to be included. In addition, we've got to provide them with instructions on exercising their rights, including exercising the rights that they acquire by virtue of making an investment, such as a right to vote the securities that are being bought as part of their investment, and any tender rights. Now, in addition to those rights, we've got to provide them general information about the plan's investment alternatives. And those are typically, in a 401k plan, those are typically going to be mutual funds or investment funds that are available for participants to select. In that regard, you've got to provide them with what those designated investment alternatives are, and then we're going to get into a little bit more in terms of what specific information is required with respect to each of the investment alternatives. You also have to provide them with the identification of the persons who are designated by the plan to receive the instructions from the plan participants and beneficiaries. And that's, again, going to typically be your record keeper or somebody who's involved in the administration of your plan. Finally, if you have any separate investment arrangements, and what those typically are self-directed brokerage accounts, where somebody, if your plan allows for somebody to select their own broker and go outside of your designated alternatives, then you have to provide that information that's available, and also the what additional costs may be associated with having a brokerage window.
Jim, a number of those items, as a plan sponsor, they've been providing that over the years. Some of this would be new. Practically speaking, they have that responsibility as a plan sponsor to make sure this information is being given to the appropriate people. Where do you think that's going to be done? At the plan level, at the SPD level, a separate document, or a combination of all? What do you think?
Yeah, Richard, that's good. What we anticipate, and the rules don't say exactly where or how you have to provide it, as long as you're providing it. But what we anticipate is this general plan information should, in our view, be included with a general document such as a summary plan description, so that the information about the fact that they're able to direct the investments and the limitations that might apply would be in the general document. Now, some of the more specific information where we have to get into that has to be updated either quarterly or annually, we would anticipate that's in a separate disclosure piece. And we'll talk a little bit more about the specifically related to investment information that has to be updated. And our thought is that's going to be a separate piece of information that is disseminated probably at least annually. I might add these disclosures can be broken down in addition to these pieces of information that we're talking about. Some of the information that we've talked about so far has to be provided at either initially when the person first becomes eligible to direct their investment, and then in addition annually thereafter. So with respect to our new requirements, we're going to have an initial wave of disclosures that are going to go out, and then we're going to have to do that annually. And as new participants become eligible, we need to be providing them with the annual disclosure that we have. So, in addition to the information about how to direct their investments and what's available, we've got to provide information about expenses, and the expense information that has to be provided can be broken down into two general categories. One is the expenses that are incurred by the plan on a plan-wide basis that get charged to participants' accounts, and examples of that. These are plan-wide expenses, such as the expense of an auditor to do the audit of the plan. That's a plan-wide expense. All the participants in the plan theoretically benefit from that expense. That expense is a proper expense to charge to the plan, but the plan sponsor at least doesn't necessarily have to have that charge to the plan. The plan sponsor can pay that himself. So on these plan-type expenses, if they're going to be charged to the plan, they have to be disclosed. The fact that they are going to be charged to the plan needs to be disclosed, and then the basis for how they get allocated among the participants' accounts has to be disclosed. And generally, the basis is either going to be on a per capita basis, which means that each participant gets an equal share of the expense, or on a pro rata basis, which is typically on the basis of the size of each participant's account. So we have to disclose not only the fact that we're going to charge those expenses, but how they get allocated. Now, again, no disclosure is required if the plan sponsor is paying those expenses and the plan is not being charged to them, even though they are proper, quote, plan expenses. Now, the second category of expenses that we have to consider are those that are really individually related. And these are the kinds of fees and expenses that could be charged directly to a participant's account. And examples of those are the fee that a plan may charge for a person to obtain a loan from the plan, the fee, if any, that's charged to process a qualified domestic relations order or any other distribution, and then any other specific investment fees that might be provided. I know some of our plans have the ability to have an investment advisor assist participants in allocating their investments, in directing their own investments. And if that fee is chargeable directly to the participant, that would be a fee that would need to be disclosed as an individual fee that is charged. I might add here that at this point, changes in these plan-type information, previously when we changed plan provision, we have a requirement to disclose it as in terms of a material modification to the plan. And generally the timing of that is that it's 210 days after the end of the plan year in which the change was made. Now, changes in plans, including changes in this plan information that we've been talking about, this general information, have to be made in advance, at least 30 days and not more than 90 days in advance of the date that the change would become effective. So that's a new requirement that we need to be mindful of as we're considering making changes. So, for example, if your plan doesn't currently allow for you to charge the cost of a quadro directly to a participant's account, and you want to do that, first of all, that's probably an amendment that needs to be made to the plan to provide for that. In addition, that's a disclosure that needs to be made, and that disclosure would need to be made at least 30 days in advance of the date that the change becomes effective. Finally, the third category of expenses that we have to provide disclosures on are a quarterly disclosure of what's actually been incurred and charged. So in terms of either the plan-wide expenses or the individual expenses, we have to, on a quarterly basis, tell participants and beneficiaries and alternative payees what those expenses actually are and what has actually been charged to their account. So, for example, if the plan has charged accounting fees, auditing fees to the plan, and has allocated those to participants, then on a quarterly basis, the participant needs to receive a statement that shows what that amount is for that quarter. Similarly, if we charge a fee for processing a quadro, they're supposed to get a quarterly statement that shows what that amount is, along with a description of what the services were. That's a new requirement, a new quarterly reporting requirement. Pardon me. That the requirement actually is complied with if it's done within 45 days after the end of the quarter. So for this year, we've got a quarter that's going to end for calendar years on June 30th. And so we will have a reporting requirement, a disclosure requirement that's going to be effective August 14th.
So from a practical standpoint, Jim, the plan-wide expenses, again, on all expenses, the plan sponsor has the responsibility to make sure that these disclosures are being made. Practically speaking, if you have a Fidelity as your investment advisor in doing their family of funds, they have this responsibility probably for all of their plans. So more likely than not, the plan-wide expense disclosure will be done on your behalf by them, whoever the provider is, to your participants.
That's exactly right, Richard. I think that the vast majority of plans and employers are going to have to look to their record keepers and service providers to actually comply with these requirements. In part because the plan sponsor or employer, in all likelihood, doesn't even have the information.
Right. But they have the responsibility. So, Bill, on the contractual side of things, when they're entering into that contract with whoever that provider is, they need to make sure that responsibility has shifted from them as the plan sponsor to the provider.
Now, Richard, that's a great point. As I've reviewed a number of these new service provider contracts, there's a new provision that I've seen pop up with some smaller record keepers. And that provision is, we are not going to allow you to pay for audit fees, legal fees, other fees out of the plan assets, because they don't want to be responsible for the fee disclosures that are associated with that. And I've had some clients who just signed their fee disclosure and haven't read it closely, who are thinking, yeah, I'm going to take my audit fee, my $10,000 fee out of the plan, and with the new changes with the record keeper, we have many of them not going to allow you to do that anymore.
So even though the plan document gives you that option, if
right.
you sign the contract you're referring to,
right.
you may be prohibited from doing that because of the agreement you had with the provider.
Right, so everyone needs to double-check the language and make sure that the providers are still going to let them charge those fees.
And Jim, back to the individual expenses, though, on a quadro, for example, the service provider may not even know that's necessarily going on. Maybe they are, but would more likely than not the plan sponsor be responsible for tracking that, or would that be another expense that the service provider would also have information on and provide to that individual participant?
Yeah, ideally, I would say that the record keeper you would want to look to the record keeper to do all of that. In part because the record keeper is going to know some of that information, and the plan sponsor won't know it at all. The plan sponsor, for example, won't necessarily know who has taken a distribution, who has taken a plan loan. So ideally, I think we want our record keepers to be the source for all of that information, including the fact that the plan sponsor may have authorized some other payments to come out. I think they're going to the plan sponsors of the two parties, the record keeper and the plan sponsor. The record keeper is going to be in the best position to accumulate and to be able to report that information. So, in addition to expense-related information, we've got new required investment-related disclosures. And let me just back up and slow down a bit here. A number of our plans have been what were called 404C protected plans. They were plans that were voluntarily complying with a number of these disclosure requirements in order to avail themselves of the protection that's provided under Section 404C of ERISA, which says if you provide a participant with the ability to direct the investment of their own account and you provide them with sufficient information, that the fiduciary is not liable for losses that result from the investments that are directed by the participant. These new disclosure requirements, which are now required of all plans that provide for participant direction of investment, these new requirements mirror now what is now required under 404C. So, whereas before it was voluntary, a lot of our plans were trying to comply with 404C. So much of this information, and particularly the information that we're about to talk about concerning the investment-related disclosures, have been made, or most plans have been attempting to comply with this. It is now going to be mandatory that we comply if we're going to give participants the right to direct their own investments. So, with that said, this investment-related disclosure, first let me talk about the format that they require that it be in. And basically the format has to be a comparative format where you're comparing the various investment alternatives that are available as well as benchmarks for each of them. And it's anticipated that this would be done in the form of a chart. And in fact, the Department of Labor has a model chart that will suffice in terms of the format. Now, in addition to the comparative information on the investments that has to be provided, the chart also has to provide contact information for the plan administrator or other personnel that from which additional information can be obtained, and a statement that information is available on a website. And that's another requirement that we're going to talk briefly about later, but there also will have to be a website that is available to participants to access and to obtain the most up-to-date information. Now, the specific content, basically there are four elements of the format or required disclosure, and that is the identifying information for each of the investment alternatives, performance data, the benchmarks to which the investment alternative can be compared, and then the fees and expenses that are charged inside the investment alternative. So, for example, if we have a Fidelity, and I don't want to be picking on Fidelity here necessarily, but let's say we have a Fidelity mutual fund that's one of our investment alternatives. We have to identify that fund. We have to provide performance data with respect to that fund. We have to provide an appropriate benchmark, and then we've got to tell participants what the fees and expenses that Fidelity charges for managing that fund. So let's talk some specifics about what these various elements of information are. In terms of identifying information, we've got to have the name of the fund, obviously, and then we've got to provide a description or type or category of what the fund involves. So, for example, if it's a balanced fund, we have to call it a balanced fund. If it's a large cap fund, if it's a intermediate bond fund, all of those have to be somehow identified on the chart. Secondly, we've got to have performance information, and that's the performance data is basically how well the investment has performed in terms of whether it has made money or lost money. And if you have a variable rate of return, in other words, a return that is not a fixed return, and that's going to be almost all of your mutual funds other than perhaps a money market account. Most of your mutual funds are going to have variable rates of return, and in that case, you have to provide the performance data is how well they have done, whether they've made or lost money on a 1, 5, and 10 calendar year period, or if if the fund hadn't been around that long, just the life of the fund. And again, the performance chart has to have a statement, and there's a number of statements that have to go along with this performance chart, and one of them is something that you've probably seen in everything you've ever gotten from a broker or from a stock brokerage, and that is that the investment's past performance is not necessarily an indication of how it will perform in the future. So, now, if you do have in performance data, if you do have a fixed return or a stated return, then you've got to identify what that stated return is and how it can be adjusted in the future. If there's a guaranteed minimum amount, then that has to be provided, and then again, you have to provide indications that if the return can be adjusted, how you can obtain the most recent version.
Jim, I want to stop you right there. As we're talking about fixed return investments inside a plan, I see a lot of these have restrictions where you can only move X amount of dollars, or say 20% a year out of a guaranteed interest account. Doesn't that now have to be disclosed also on the restrictions of moving those funds?
That's right, Bill. Any restriction on the ability to get either in or out, or any cost that's associated with that, will need to be disclosed as part of this investment information. Okay. So for example, if you can get out once a month, you can take one distribution a month and no more, then that restriction has to be applied. Similarly, if there's a cost associated with it, either by virtue of a termination or liquidation fee, a back end fee, that fee's got to be disclosed. And some of this is almost common sense, in that what they're trying to make sure that's happening is that participants and beneficiaries have sufficient information to decide whether this investment is the one that they want. And so, for example, in what you just brought up, Bill, let's say I'm a short-term person. I'm needing to retire soon, and I want to pull some money out. I'm not going to want to be in a plan. I want to know if I'm making an investment that it's going to cost me something to get out of it. So that you can kind of almost intuitively think through some of these things that some of this actually does make sense. In terms of benchmarks, these are the comparisons to either an average or an index of some sort that will allow participants to judge how well a particular investment alternative is performing in comparison to the benchmark. Now, for the benchmarks for investment alternatives that have variable rates of return, the disclosure, the benchmark has to include the name and returns on a broad-based securities market index over the 1, 5, and 10-year period, so that they're able to do an apples-to-apples comparison of the particular investment alternative that you are providing to this benchmark. The benchmarks generally shouldn't be something that is administered by the issuer of the investment alternative or an affiliate of theirs, unless it is something that is widely recognized. I think that, what we see is Morningstar provides benchmarks, or the benchmark could even be the S&P index. Your index fund could be compared to the actual S&P index. The Department of Labor has indicated that a blended benchmark does not comply unless it's proportional to the fund's holdings. So if you've got a blended fund, you need to consider whether that blended fund complies with these disclosures.
Back at 40,000 feet, considering the plan sponsor in most cases, or in many cases, aren't sophisticated enough in the investment side of things, shouldn't be. That's not their day job. They want to make sure they're passing that responsibility on to the provider that is complying with these benchmark requirements, and in their contract make sure that they have that responsibility. So if in fact they do somehow violate the DOL's rules here, that the plan sponsor has some accountability economically back to the party that was providing this disclosure.
Absolutely, yeah. This is probably the place where the plan sponsor would have the least ability, right, to develop and maintain this kind of information themselves. It really is a realization that when a plan sponsor, when an employer is sponsoring a retirement plan, they've jumped off into a separate line of business, if you will, and they need to make sure that in doing that, they know that they're not, for the most part, qualified to do most of the things that are required in connection with the administration of the plan, and they need to have service providers, professionals that in fact do know that. It really is it's really a separate line of business. It's not part of most employers' business plan to know how to manage retirement assets. So in addition to the benchmarks and the performance data in connection with investments, we've got to provide fee and expense information, and this is different from the fee and expense information that we were talking about before that gets charged directly to a plan. These are the fees that the mutual fund provider, the Fidelity or Vanguard, charge to the mutual fund itself for the investment of the assets or the management of the assets, or for any other services that they provide to the investment alternative itself. And now these include anything that can be charged directly against a participant's investment, such as a liquidation fee or a back-end fee. It also requires to have disclosure of the annual operating expenses on a percentage basis, and then the total amount of operating expenses that are charged for the year. And finally, we have to have statements, a couple of statements, one indicating that fees and expenses are only one of several factors that should be considered in making investment decisions, and a statement that the cumulative effect of fees and expenses can substantially reduce the effectiveness of the investment. So if I'm making an investment, even though it looks like it's earning 10% a year, if I have to pay out 5% in expenses for making that investment, it reduces the effectiveness, and that's the point that they're trying to get to. Finally, in connection with the plans, as I indicated, we have to disclose the annual operating expenses. Those are the expenses that the mutual fund provider charges for managing the assets, and they typically have a management fee that gets charged on an annual basis, and that again reduces the amount of return for the investment. So, finally, the one final area of disclosure that we have to have is we've got a requirement that we have a website, and the website has to be made available to participants, and they must have the ability to access that website with a PIN or their particular name, and it's got to have basically all of the information that we've been talking about lately, all of the information about fees and expenses and the investment returns and the benchmarks. All of that has to be on this website. Again, Richard, this is something that there's just really not. It's the very rarest of employers that's going to be in a position to develop their own website with this type of information. That's got to come from the record keepers and the other third-party administrators that are involved in the management of the plan. There is some protection that is provided to plan administrators and plan sponsors in connection with the development of these websites, and that is that the plan sponsor can be exonerated or is not liable, at least, for the completeness and the accuracy of the information that's provided if they are reasonably in good faith relying on information provided by a service provider. again, we think that requires that their service agreement somehow address the fact that the website requirement is going to be provided and that the disclosure requirements are going to be met. I don't know, Bill, I haven't seen any service agreements lately that specifically address the development of the website. What I have typically tried to do is to say that the service provider, when in representing a plan sponsor, I try to get the service provider to agree that they will do whatever is necessary to comply with whatever rules and regulations are applicable. Some of them have balked on it because that is a fairly broad requirement, but I would think that most of them would be willing to at least specifically include in the service agreement the fact that they're going to be responsible for these things that we're talking about, the website, the development of the disclosures, the benchmarking of information.
Jim, I think it's going to help us going forward that many of these things, at least for our clients, we recommended for the reasons you said. Most of these are practical in nature. And as a result, sometimes there was pushback from the provider just because they weren't mandatory and they didn't want the responsibility. Now every employer that sponsors a plan has to have this. Either they have to do it or their providers have to do it. So the providers now are going to be more inclined and on a regular basis being provided this information to their plan sponsors, or they won't be able to keep the business. So I think we're going to find less pushback on that. But we need to make sure, especially on the contractual side of things, that we have that in there because first and foremost, and Bill referenced it, the plan sponsor is the quarterback. Now, if they option it off to somebody else, it's permissible to do, provided that group has the ability to do it and typically does. But until you do get rid of that responsibility or get it shared with somebody else, that is the plan sponsor's responsibility, whether or not they have the ability or the information to get it or not. If they don't, and in most cases they wouldn't, they need to make sure that they have that in the contract so that somebody's providing it. Otherwise, the Department of Labor is going to be knocking on their door.
Let me add, just as the final item on our written material or our materials, our PowerPoint materials. In addition to providing the website, the website has to provide a glossary of terms, and again, that's to allow participants to understand what they're doing when they direct their investment, and that glossary is supposed to include the investment and financial terms that participants would find relevant in connection with the investment alternatives that are available. So, again, you have to disclose what does it mean to have a rate of return. How is that important? Since we have a couple of extra minutes, it looks like I might add a couple of things that aren't in the written material. One is that we're anticipating some additional regulations that have been proposed with respect to target date or lifestyle funds. I don't know if you've kept up at all. You know that target date funds are funds that are supposed to be blended in such a way that they anticipate a participant's need to take withdrawals, and so that they are maybe weighted in terms of greater risk early in a person's life, and then into less risk and more stable funds on a going forward closer to retirement basis. We're anticipating some additional disclosure requirements with respect to target date or retirement funds, and that specifically includes what the costs are in addition to general expenses that might be charged for participating in the target funds. The other thing is that a lot of these disclosures can be made electronically. If you're set up for electronic disclosure, and that is either because participants have given you an email address to which they would like to receive any disclosures, then you can use that. Or if disclosures can be made as part of the person's normal business activity on the job, then those disclosures these disclosures that we're talking about here can be made electronically through those alternatives. We have a couple of questions that have been posed so far that we want to go through. You want to take the first one, or Bill?
I'll take the first one. First question is, how would a forfeiture account use of plan funds to cover plan expenses be reported in this new disclosure? That's a good question. Forfeitures anything held in a forfeiture is still treated as plan assets. And if you take X dollars out of your forfeiture account to pay plan expenses, legal expenses, record-keeping expenses, those have to be reported on the quarterly report to the participants saying X amount of dollars out of the forfeiture account were used to pay X amount of dollars for plan expenses. Agree with that, Jim?
Yes. So just because they're coming out of the forfeitures doesn't mean they're not being paid by the plan.
And that answers another question that we received, and that was, so if we charge participants a loan fee or 401k provider charge as an administrative fee to the participants who has a loan, this reg applies?
The answer is yes.
The answer is that's yes.
Correct.
And so you'd need to disclose that. And the third question, and probably the last one we'll have time to address. Jim, you want to, I think it's clear, but just want to clarify if a plan sponsor actually pays all expenses associated with the plan, because this is an important question because a number of them do. The regs don't apply, including audit fees and management fees, et cetera. If the plan sponsor pays every fee known to mankind and doesn't charge the participant anything, has anything changed?
No, that hasn't changed. Now, I might qualify that slightly in that a lot of plans allow for the plan sponsor to charge those fees, but the plan sponsor chooses not to. If the plan allows for that, I think our plan disclosures would require that we say that the plan sponsor can do that, but the fact is that none of those expenses then would be disclosed because they haven't been incurred. So,
and with all due respect to the plan sponsors, now I'm back to what Bill alluded to early on, and we'll end this, I guess, the way we started it, and that is sometimes the providers have not been completely, and forthright's not the right word, but on a full disclosure. So we need to make sure that maybe the plan sponsor thought they were paying all the fees, but maybe there are some compensation, such as indirect compensation or direct compensation and other things that are out there that theoretically still would need to be disclosed to the participants or to the plan sponsor as it relates to that.
That's exactly right. Those and quite frankly, I think some of those fees are what these regs have been targeted by.
Right. Well, we're at the end of our presentation time. We really want to thank you for participating in today's webinar.
So we'll follow up.
Absolutely, we will follow up with the just a quick reminder. First of all, you'll be receiving a survey next week, along with the access to any answers to questions submitted throughout the presentation. We also want to remind you that this webinar will be archived on the McAfee & Taft website, which is www.macafeandtaft.com. So in case you missed part of today's presentations, or if you want to go back and listen to it again, likewise, you all also have the ability to pass this on and share it with anyone, either in your office or otherwise, in the event someone might benefit from the information. We will also be providing you, as additional information becomes available to us, if any of the dates are moved back. We'll do an email blast. We will try and keep you apprised as soon as we get this. This is fluid. And in the great scheme of things, as benefits attorneys, we always think the items that we're dealing with are important. But this one has a short time fuse. It does have an impact on all plan sponsors. And so this is one that we want to emphasize to you that needs to be addressed, and we need to make sure that you get that passed along. To that end, we also want to alert you to the fact that we have another Employer Link webinar coming up in 2 weeks. It's a Valentine's Day special on February 14th. Our employment attorneys, Charlie Plum and Paul Ross, will be presenting the wage and hour laws in compliance out of trouble to help employers gain a more thorough understanding of the Department of Labor wage and hour division role and authority, their new enforcement initiatives, as well as what employers can do to stay in compliance and out of trouble. You can go to our website again for more information and to register for the webinar. Thank you specifically to Jim Prince and Bill Frudenrich for today's presentation and their insight on this very timely topic. And again, thank you for joining us, and have a great afternoon.